You're watching the news right now, aren't you? Checking your phone every few hours to see what's happening with gold and silver prices, waiting for some talking head on CNBC to tell you it's time to buy. And that's exactly how you're going to miss the biggest wealth transfer of your lifetime. Because here's what nobody's telling you. By the time the mainstream media is screaming about precious metals, the real money has already been made. The institutions have already positioned themselves. The smart money has already moved. And you're left chasing a train that's already left the station, buying at prices that are 30, 40, maybe 50% higher than where they are right now. Let me show you something that should terrify you. In 2008, when the financial crisis hit, gold was trading around $800 an ounce. The news wasn't talking about it. Financial advisors were still pushing stocks and real estate. Then the crisis exploded into public view. Lehman Brothers collapsed. The headlines screamed, and suddenly everyone wanted gold. By the time the average investor heard about it and decided to act, gold had already rocketed past $1,000. They bought it $1,200, $1,400, even $1,800 at the peak in 2011. They were 3 years late to a party that had already started. The same thing happened in the 1970s. Gold sat at $35 an ounce for years. Nobody cared. The news ignored it. Then inflation started creeping up. Oil shocks hit. The dollar weakened. But the mainstream media was still telling people everything was fine. By the time they started covering gold seriously, it was already at $400. The real explosion happened after that, sure, but the people who made generational wealth were the ones who bought at $100, $150, $200. Not the ones who waited for permission from the evening news. Right now, we're in that exact same window. Gold is hovering around record highs, yes, but the mainstream narrative is still focused on stocks, on tech, on the next hot cryptocurrency. Turn on any financial channel and they're talking about everything except what's actually happening in the precious metals market. And what's happening is absolutely extraordinary. Central banks are buying gold at a pace we haven't seen in over 50 years. In the last quarter alone, they added over 300 tons to their reserves. That's not a small number. That's not a hedge. That's a full-scale repositioning. The People's Bank of China has been buying every single month for over a year straight. Russia, despite sanctions, despite being cut off from Western financial systems, continues to accumulate. Turkey, India, Poland, Singapore, they're all loading up. These aren't emotional retail investors making panic buys. These are the most sophisticated financial institutions on the planet, with access to information and analysis that you and I will never see. And they're moving billions of dollars into physical gold. Why? Because they know something. They're not waiting for the news to tell them. They're not waiting for confirmation. They're acting on intelligence and analysis that tells them the current financial system is approaching a breaking point. Look at what's happening with the BRICS nations: Brazil, Russia, India, China, South Africa, and now they're expanding. Saudi Arabia is joining. The UAE is joining. Egypt, Ethiopia, Iran. These aren't small players. These are countries that represent nearly half the world's population and a massive chunk of global GDP. And they're all working on the same project: reducing dependence on the US dollar. They're creating alternative payment systems. They're settling trade in their own currencies. They're backing those currencies with gold. This isn't conspiracy theory. This is documented policy. China and Russia have been settling oil trades in yuan for years now. Saudi Arabia, the cornerstone of the petrodollar system, is now accepting yuan for oil sales. Think about what that means. For 50 years, oil could only be bought with dollars. That created automatic demand for dollars worldwide. Every country needed dollar reserves to buy energy. That system is cracking, and when it breaks, the implications for dollar holders are catastrophic. But the news isn't covering this. They mention it in passing, maybe a 30-second segment buried in the middle of the broadcast. They're not connecting the dots. They're not showing you the bigger picture. Because the bigger picture is uncomfortable. It challenges the narrative that everything is fine, that the dollar is strong, that you should keep your wealth in paper assets denominated in a currency that's being systematically devalued. Let me tell you about a guy named Jim. Jim's a retiree, 68 years old, worked his whole life as an engineer, saved diligently, built up a nice nest egg, about $800,000 in his 401k, all in traditional investments, stocks and bonds, just like his financial advisor told him. In 2020, when gold was around $1,500 an ounce, Jim started getting nervous. He was reading things online, seeing the money printing, the stimulus packages, the debt levels. He asked his advisor about gold. The advisor laughed it off. Gold doesn't pay dividends, he said. It's a barbarous relic. Stay the course. Jim listened. He stayed in stocks. And sure, his portfolio went up for a while, but then inflation hit. Real inflation, not the cooked numbers the government reports. His grocery bills doubled. His insurance premiums skyrocketed. His property taxes went through the roof. And even though his portfolio showed gains on paper, his actual purchasing power was eroding. By the time he finally moved some money into gold in late 2023, it was trading at $2,000 an ounce. He'd missed a 33% gain, and more importantly, he'd missed the protection during the period when he needed it most. Now, contrast that with Sarah. Sarah's 52, owns a small business. In early 2020, she had about $400,000 in savings and retirement accounts. She didn't wait for the news. She didn't wait for permission. She looked at what was happening, the unprecedented money creation, the debt explosion, the geopolitical tensions, and she made a decision. She moved 30% of her liquid wealth into physical gold and silver. Bought gold at $1,600, bought silver at $18. Her friends thought she was crazy. Her family questioned her judgment, but she understood something they didn't. The news is always late. Today, Sarah's precious metals position has significantly outperformed her traditional investments. But more importantly, she sleeps at night. She's not worried about bank failures. She's not worried about currency devaluation. She's not checking her phone every hour to see if the market crashed. She positioned herself before the crowd, and now she's watching everyone else scramble to catch up. This is the pattern throughout history. The masses wait for confirmation. They wait for safety. They wait for the news to tell them it's okay to act. And by the time that confirmation comes, the opportunity has passed. The early movers, the people who do their own research and make their own decisions, they're the ones who preserve and grow their wealth. Everyone else is left fighting over scraps. Right now, we're seeing signs that should be flashing red for anyone paying attention. The commercial banks, the big players on the COMEX futures exchange, they've been covering their short positions in gold. For years, these banks held massive short positions, essentially betting against gold. That's been their game, suppressing prices through paper contracts. But over the last several months, they've been quietly closing those positions. They're going neutral. Some are even going long. When the people who've been betting against something suddenly switch sides, you need to pay attention. The gold-to-silver ratio is another screaming signal. Historically, this ratio averages around 60-1, meaning it takes 60 ounces of silver to buy 1 ounce of gold. Right now, we're still elevated from historical norms, even after recent moves. When this ratio is high, it typically means silver is undervalued relative to gold, and when it corrects, silver doesn't just catch up, it explodes. In 2011, silver went from $18 to $48 in a matter of months. The people who positioned themselves in silver before that move made life-changing returns. The people who waited for the news bought at $40 and watched it crash back down. Here's what's really happening behind the scenes. The physical market and the paper market are diverging. On the COMEX, you can buy and sell gold contracts all day long. Billions of dollars in paper gold trades hands. But when people start asking for physical delivery, suddenly there are delays. Suddenly there are premiums. Suddenly, the metal isn't as available as the paper contracts suggest. This is a classic sign of a market under stress. The paper price is being held down by unlimited contract creation, but the physical metal is getting harder to find. Look at what happened with the silver squeeze in early 2021. Retail investors coordinating online decided to buy physical silver, not paper contracts, actual metal. Within days, dealers were sold out. Premiums exploded. The U.S. Mint couldn't keep up with demand for silver eagles, and this was just retail demand, a tiny fraction of the market. Imagine what happens when institutional money, when sovereign wealth funds, when pension funds decide they want physical metal. The paper price becomes irrelevant. The physical price goes to wherever it needs to go to clear the market. The smart money knows this. That's why they're accumulating now, while the news is still quiet, while the average investor is still focused on stocks and bonds and whatever the latest trend is. They're not waiting for a crisis to hit the headlines. They're positioning before the crisis becomes obvious to everyone else. And speaking of positioning, if you're sitting on retirement accounts, if you have $100,000 or more in traditional IRAs or 401ks, you need to understand that you have options most people don't know about. I put together a comprehensive guide on how gold IRAs actually work, how you can get physical precious metals into your retirement account without triggering taxes or penalties. It's completely free. Link is in the description below. This isn't about timing the market perfectly. This is about having a portion of your wealth in something that's protected you through every financial crisis in human history. Worth looking into if you're in that situation. Now, let's talk about what's coming. The debt situation in the United States is beyond unsustainable. We're adding $1 trillion to the national debt every 100 days. Think about that. $1 trillion every 100 days. The interest payments alone are now over $1 trillion a year. That's more than we spend on defense, more than we spend on Medicare. We're borrowing money just to pay the interest on the money we already borrowed. This is the definition of a debt spiral. And there are only 3 ways out of a debt spiral. You can default, which destroys your credibility and access to future borrowing. You can implement brutal austerity, cutting spending and raising taxes, which is political suicide and causes massive social unrest. Or you can inflate your way out, printing money to pay off debts with devalued currency. Guess which option governments always choose? They're going to print. They have to print. There's no other politically viable option. And when they print, when they create trillions more dollars out of thin air, what happens to the dollars you're holding? What happens to your savings, your retirement accounts, your cash positions? They lose purchasing power. Not might lose. Will lose. It's mathematical certainty. Gold and silver don't care about monetary policy. They don't care about political decisions. They're real assets with intrinsic value. When currencies devalue, precious metals maintain their purchasing power. An ounce of gold bought the same amount of goods 100 years ago as it does today. Can you say that about the dollar? In 1920, a dollar had the purchasing power of about $15 today. The currency lost 93% of its value. Gold didn't. This is why central banks hold gold. This is why the wealthy have always held gold. It's not about making a quick profit. It's about preserving wealth across generations, across currency crises, across the rise and fall of empires. And right now, we're watching the slow-motion collapse of the dollar's global dominance. It's not going to happen overnight. It's going to be a process that takes years, maybe decades. But the direction is clear, and the people who position themselves early are going to be the ones who come out ahead. The news will eventually catch up. They always do. There will come a day when gold is the lead story, when silver is trending on social media, when your neighbor is talking about precious metals at the barbecue. And on that day, you'll know you're too late. The real gains will have already happened. The protection will already be in place for those who acted early. Everyone else will be panic buying at elevated prices, driven by fear instead of strategy. I've watched this cycle play out multiple times. In the late 1990s, gold was under $300 an ounce. Nobody cared. The news was all about tech stocks and the new economy. Gold was dead, they said, a relic of the past. Then the dot-com bubble burst. Then 9/11 happened. Then the wars started. Then the housing bubble formed and burst, and gold went from $300 to $900. The people who bought at $300, $400, $500, they made fortunes. The people who waited for the news bought at $1,500 and higher. We're in a similar setup right now. The mainstream narrative is still focused elsewhere. The news is still telling you to stay in traditional assets. Your financial advisor is still pushing the 60/40 portfolio. But underneath the surface, the foundation is cracking. The debt is unsustainable. The currency is being debased. The geopolitical order is shifting. And the smart money is moving. You have a choice. You can wait for permission. You can wait for the news to tell you it's safe. You can wait for confirmation from the talking heads and the financial advisors who have every incentive to keep you in the system. Or you can look at the evidence. Look at what the central banks are doing. Look at what the billionaires are doing. Look at what history teaches us, and make your own decision. The window is still open. Gold and silver are still accessible. The premiums haven't exploded yet. The supply chains are still functioning. But that window is closing. Every month that passes, more people wake up. More institutions position themselves. More sovereign nations diversify away from dollars. And when the tipping point comes, when the news finally catches up to reality, the rush for physical metal is going to be unlike anything we've seen before. Don't let the news tell you when to buy, because by the time they're telling you, it's already too late. The opportunity isn't in following the crowd. It's in positioning yourself before the crowd realizes what's happening. That's how wealth is preserved. That's how generational security is built. Not by waiting for permission, but by acting on evidence and logic while everyone else is still asleep. The question isn't whether this is going to happen. The question is whether you're going to be positioned when it does. Are you going to be like Jim, who waited for his advisor's approval and missed the move? Or are you going to be like Sarah, who trusted her own analysis and protected her wealth before the crowd caught on? That decision is yours to make. But make it based on evidence, not on what the news is telling you, because the news is always late.